Markets are cautiously optimistic as stocks and the U.S. dollar edge higher following the Federal Reserve's first interest rate cut of the year. But here's where it gets controversial. The real focus is shifting to the Bank of England's upcoming decision, and that's stirring up fresh uncertainty. On Thursday, both European equities and U.S. futures saw modest gains after the Fed's move, which came after a meeting that was surprisingly calm given the political tensions surrounding it. This steady approach helped lift the Pan-European Stocks 600 index and Wall Street futures by about 0.5%, even though U.S. markets had a mixed reaction the day before. Asia's markets had already been on the rise overnight. Chinese stocks reached a 10-year peak, buoyed by enthusiasm from local chip makers following news that U.S. tech giant Nvidia faced restrictions in China. Meanwhile, South Korea's Kospi, Taiwan's TAIEX, and Japan's Nikkei all closed more than 1% higher, signaling broad regional strength. The dollar's slight rebound, up nearly 0.2%, offered some relief after it recently plunged to a 3.5-year low, a drop that has been frustrating for companies outside the U.S. that rely on exports. Yet, analysts warn this might be temporary. The Fed's so-called dot plot, which forecasts future interest rate moves, suggests 2 more cuts before the end of the year, but only one in 2026. Fed Chair Jerome Powell emphasized that the central bank doesn't need to rush further rate changes, though he left the door open for adjustments if conditions shift. Richard Cochinos from RBC Capital Markets explained, "We try to look beyond short-term market swings to the bigger picture. Right now, we still expect the U.S. dollar to weaken, especially as U.S. interest rates are projected to fall to around 3% next year. In Europe, the euro remains steady at about $1.1825, and the British pound held firm near $1.36 as investors awaited the Bank of England's rate announcement. The BoE is widely expected to keep its benchmark interest rate at 4%. But the real question is whether it will slow down its aggressive bond buying reduction program. This program, which currently shrinks the government bond holdings by £100 billion annually, has recently faced volatility in the UK bond markets. A Reuters survey of economists predicts the BoE will reduce the pace to a median of £67.5 billion, $92.2 billion. A more significant slowdown than the £72 billion pace suggested in the bank's own August poll. This potential shift could have major implications for the UK economy and financial markets. Elsewhere, the Norwegian krone softened slightly after the country's central bank announced a 25 basis point rate cut earlier, though it remains near a 3-year high against the dollar and a 2-month peak versus the euro. Meanwhile, China's yuan inched up after the People's Bank of China kept the borrowing cost for its 7-day reverse repurchase agreements unchanged overnight. In contrast, New Zealand's dollar dropped sharply following data revealing the economy contracted more than expected. The Australian dollar also slipped 0.4% from a near 1-year high reached the previous day, weighed down by weaker than anticipated labor market figures for August. Bond markets continued their rally, with the yield on the benchmark 10-year U.S. Treasury note falling to 4.06%, and the 2-year yield, which often reflects expectations for Fed rate hikes, dropping to 3.53%. Germany's 10-year yield, a key benchmark for the Eurozone, also edged down slightly to 2.67%. However, political tensions in France caught investors' attention as French bond yields rose above those of Italy. A rare and notable development. In commodities, oil prices dipped modestly, with Brent crude falling 0.2% to $67.87 per barrel. Meanwhile, gold, often seen as a safe haven during uncertain times, nudged up 0.2% to $1,665 per ounce. This complex mix of central bank policies, geopolitical tensions, and economic data is creating a delicate balancing act for investors worldwide. The Fed's cautious rate cuts, the BoE's potential shift in bond buying pace, and political jitters in Europe all contribute to a market environment where every move is closely scrutinized. So, What do you think? Is the Fed's approach the right one to support growth without overheating the economy? And will the Bank of England's next steps calm or further unsettle the markets? Share your thoughts below, because this is exactly the kind of debate that shapes the future of global finance.